Kelly, we were in a pretty severe housing shortage even before all this happened. And then when the economy shut down, not only did sellers pull their listings, but those about to list in the usually busiest spring market put that off. So take a look at supply. It basically fell off a cliff in April. And now new listings are still down 20% annually and total listings are down 22%. That according to Realtor.com. And the builders were clearly unprepared for this quick recovery in demand. Single family housing starts and permits plunged in March and April. And with labor and supply issues now, it will be very hard to ramp it up fast. Now, even before COVID, the market was short about 350,000 homes per year in light of household formation, according to the Urban Institute. This is going to make the market increasingly expensive, especially at the entry level, where demand is, of course, the strongest. Kelly?
And why the shortage going into this? Is that still a legacy of the kind of housing bubble and crash?
Well, it was a legacy of the subprime mortgage crisis. You had nearly 9 million homes go into foreclosure, and of those, 5 million were purchased by investors who turned them into single-family rentals, and that's a very lucrative market. People thought they would sell them off. They did not. So that's 5 million homes that used to be for sale now as rentals.
Interesting. Maybe they should give them the rent-to-buy option if that's the way it's going these days. Diana, thanks very much. Diana Olick with the status there. Housing has been a rare source of strength. New home sales rose nearly 1% this week, defying expectations of a massive drop. Home purchase apps are up 54% month on month, despite the pandemic. But as Diana pointed out, there are critical pressure points to watch in the market going forward. Let's bring in Tim Mayopoulos. He's the former Fannie Mae CEO and the current president of Blend, which is a startup digitizing commercial banking. Tim, it's good to have you back. And I am curious what you make of just the kind of surprising strength in the housing market right now.
Well, it's good to be back with you. Thank you. This has been a pretty remarkable story. Obviously, going from March into April, we saw this dramatic increase in unemployment spike, unlike anything we'd seen since the Great Depression. The number of people asking to stop making payments on their mortgage loans, be in forbearance, climbed to over 8%. That number was less than 1% in March. And then, as Diana was noting, the number of participants in the market, the number of listings in the market had fallen back significantly. But there's some really good signs of a rapid recovery here. Obviously, low rates have kept refinance activity very high at roughly 2 times what it was last year. And purchase activity is really starting to rebound. We see more sellers putting their properties on the market, more buyers coming out to buy. And certainly the data I'm looking at, including data we have at Blend, shows that purchase apps really fell off quite significantly from March into April, maybe down 30%. But by earlier this month, they were back up where they were in March, and now they're another 20–25% higher than that. So It looks like people are coming back to the market.
I can tell you people in the suburbs of New York City, whether it's New York, Connecticut, New Jersey, I mean, they are getting inundated with people who are looking for homes to purchase and who want to do so quickly. I'm curious about another aspect of the mortgage market that's been a big headline and a big source of concern, mortgage forbearance, which, of course, is meant to help people throughout the pandemic. And there was big demand immediately, which threw the mortgage market itself into some disarray. I think they're still kind of trying to figure that out. But it's really slowed down lately. It's slowed down substantially. I suppose we have to take that as a good sign. I guess I just wonder, after this program is up, what happens if people run into trouble later in the year, next year, and so forth? Would they do anything like trying to bring it back, or is this just kind of a one-time thing and we hope that maybe that was the worst of it?
Well, it is somewhat encouraging to see the number of new requests coming in slowing down. So hopefully that means that people are feeling more stable about their employment situation. But I can tell you that lenders, certainly the lenders that we work with at Blend, they are preparing for a potential wave of potential delinquencies. And so they're getting ready to modify loans if they need to, and really trying to streamline that process, use some of the lessons that we learned through the last crisis to get people back to rates and terms that they can actually afford to pay. So I think we'll see a wave of that loan modification activity coming at us in the coming months.
Well, and it was interesting how Diana said the wave of foreclosures after the last crisis. You had some investors coming into the market. Now a lot of those homes are rental properties. People are looking more for homes to purchase. So do you think we could avoid another round of that this time around? Avoid a round of foreclosures, avoid losing more of the housing supply to rentals and so forth?
I think we learned a lot of lessons through the last crisis. And so there was a lot of trial and error at the beginning of the last crisis to try to figure out what would work. I think policymakers have determined that. I think companies like Fannie and Freddie have learned a lot of lessons from that. So I'm not saying there won't be any foreclosures. That's certainly a risk, but I think the mechanisms to avoid that are well established now and can be implemented relatively quickly and relatively swiftly.